Welcome to Wealth Hustle 247 podcast, your trusted guide to financial literacy, business innovation, and entrepreneurial success. Learn how to grow your wealth, make informed decisions, and turn your ideas into profitable ventures.
Everyone keeps telling you, you need a high-paying job to get rich. But here's the truth that schools, parents, and even most financial advisors won't tell you. You don't need a six-figure salary to start investing. You just need the right strategy. In fact, the richer you try to become by only working for money, the longer it takes to build real wealth. The real secret isn't earning more, it's making your money work for you, starting with even small amounts. In today's episode, I'm going to show you how to start investing with as little as 5,000 Nigerian nairas. The beginner-friendly investments most people overlook. And why the traditional advice about money is keeping you poor. If you're ready to think differently about money and start growing real wealth, this episode will completely change your perspective. Let's dive in.
Welcome to today's deep dive. If you're joining us right now, it means you're someone who actively tracks the financial landscape.
Right, you're paying attention to the mechanics of it all.
Exactly. You know that wealth building isn't hidden behind some velvet curtain. You just want to cut through all the noise and get straight to the actionable strategy.
Because there is so much noise out there.
There really is. So we have a single, highly pragmatic source sitting on the desk today. It's a working paper titled, How to Start Investing with Small Money.
Which is a great title. It's very direct.
It is. And our mission for this deep dive is to completely deconstruct this framework. We're going to look at how to take whatever surplus capital you're currently generating, whether that's, just a slight margin at the end of the month or more substantial cash flow, and deploy it efficiently.
Without falling into all those behavioral traps that usually wipe out early portfolios.
Yes, the traps. Okay, let's unpack this. Because the document immediately takes aim at two massive psychological barriers that hold people back.
The myths, really.
Right. The first is this idea that without a massive initial lump sum, the barrier to entry is just too high to even bother.
Yeah.
And the second is the assumption that the market is inherently a casino, that it's excessively complicated and impossibly risky for regular retail participants.
And the author essentially takes those concepts and throws them right out the window.
Completely.
It's a total paradigm shift regarding small initial investments. And honestly, that shift is one of the most rigorous behavioral reframes I've seen in recent literature.
How so?
Well, they introduce this concept of training capital. When you're starting with a smaller surplus, you aren't actually at a disadvantage. You are basically in a highly insulated laboratory environment.
Oh, I see. Like a safe zone.
Exactly. Think about it. If your portfolio experiences a 30% drawdown,
Which hurts.
it hurts. But if you only have $500 in the market, the actual monetary loss is objectively minimal. It's $150.
But the behavioral stress test is identical.
Precisely. The knot in your stomach, the urge to panic sell, that feels incredibly real. So you are buying the emotional experience of market volatility at a massive discount.
That makes a ton of sense. The source outlines some specific numbers here, too. Whether you have $10, $50, $100, or $10,000, it's all classified as this training capital.
It's all just tuition for the market.
Right. It exists to teach you risk management, emotional discipline, and market behavior. But I do have to push back just a little bit here.
Go for it.
For an audience that already understands compounding and market mechanics, putting, say, $10 a month into a brokerage account, it almost feels like trying to fill a swimming pool with a teaspoon.
Sure.
I mean, the friction of the bank transfer alone almost seems to outweigh the financial benefit. Does the author genuinely justify such a microallocation?
It's a fair critique, especially when you factor in the time value of money. But the author's justification here is purely neurological, not mathematical.
Neurological.
Yeah. The act of moving that $10 forces you to set up the brokerage account, link the bank, automate the transfer, select the asset. You are physically building the neural pathways and the infrastructural plumbing of wealth generation.
The plumbing.
Right. So when your income inevitably scales up and that $10 becomes $1,000, the plumbing is already built. You don't have to learn how to handle a high-pressure hose while the water is already blasting.
That is a great analogy. You're building the pipes before you turn on the main valve. But before any capital actually flows through those pipes, the document mandates a strict pre-game checklist.
Yes, part one, the foundation.
And the very first requirement on that checklist is income stability. What really stood out to me is how they handle variable income.
The freelancer dilemma.
Exactly. If you're a freelancer, a contractor, or running a business with fluctuating cash flow, the rule is to invest a strict percentage of your income, never a fixed dollar amount.
Which is such a critical risk mitigation strategy for sequence of returns.
Because if you lock yourself into a fixed $500 monthly contribution,
And your business hits a dry spell,
you're suddenly cannibalizing your operational capital just to feed your brokerage account.
which creates incredible artificial distress. A percentage-based allocation breathes with your cash flow. It scales up during your bull months and retracts during the lean ones.
So you never feel financially cornered by your own investment strategy.
Exactly.
Now, the second pillar of this readiness checklist is the emergency buffer. The target is 1 to 3 months of basic living expenses sitting in cash before you initiate any aggressive market exposure.
The shock absorbers.
Right, it's like building the shocks on a car before driving it on a bumpy road. But for an audience that tracks inflation and understands yield, holding 3 months of pure cash feels like a deliberate drag on your portfolio's overall return.
Because it's dead money losing purchasing power.
Exactly.
It is a drag on returns. The text absolutely acknowledges that opportunity cost, but the mathematical argument for that drag is survival. That cash buffer is literally the only thing standing between you and forced liquidation. If a macroeconomic shock hits, say, a severe market correction combined with a personal medical expense.
The worst case scenario.
Right. And if you don't have that cash buffer, you are forced to sell your equities at the exact bottom of the market just to cover your bills. The cash drag is essentially an insurance premium you pay to protect the compounding curve of your main portfolio.
It prevents catastrophic sequence risk.
Spot on.
And the final piece of that defensive foundation is eliminating toxic debt. The paper defines this strictly as high-interest, non-leveraged consumer debt, like credit cards.
The wealth killers.
Yeah. It argues that pits this off is literally the highest yield investment you can make.
Because it's pure arbitrage. If you have a credit card carrying a 22% APR and you're trying to squeeze an optimistic 10% out of the S&P 500, you are mathematically bleeding out.
You're losing 12% right out of the gate.
Exactly. Eliminating that 22% debt is a guaranteed, risk-free, tax-free return on your capital. You will simply not find that kind of yield anywhere in the public markets.
Here's where it gets really interesting. Once that defensive baseline is established, the buffer is funded, the toxic debt is cleared, we move into part 3, the actual deployment of capital.
The fun part.
Right. And the source identifies 4 specific vehicles for small money. The first, unsurprisingly, is broad market index funds.
The staple.
The directive is simple. Buy the market instead of gambling on one company. But they attach a very strict timeline to this, a minimum holding period of 5 to 10 years.
Because that timeline is the defining mechanism of index investing. When you buy a broad market index, you are essentially capturing the aggregated growth of human productivity and corporate earnings.
But in the short term, it's volatile.
Highly volatile.
Yeah.
In any given 6-month window, that index is subject to geopolitical shocks, interest rate policy, and sheer market noise. But stretch that timeline out to a decade.
The noise cancels out.
Exactly. The underlying earnings growth becomes the dominant driver of your return. It strips the speculative gambling right out of the equation.
Okay, avenue number 2 is money market funds. The document categorizes these as low risk and lower return, but flags them as the optimal parking lot for that emergency buffer we just discussed.
Or for capital you need to deploy in the next 24 months.
Right. Why is that?
Because you're trading yield for liquidity and preservation of principal. In a high interest rate environment, money market funds can offer a respectable nominal yield, but their primary utility is capital defense.
It ensures the dollars you might need tomorrow are actually there tomorrow.
Immune to equity market drawdowns.
But the third vehicle introduces a slightly different strategy: dividend stocks.
Yeah.
And the mandate here is clear. Reinvest the dividends early, spend them later,
This is the classic DRIP, the dividend reinvestment plan.
which is a compounding engine.
It operates almost entirely independent of the stock's price action. You buy a share, the company pays you a portion of their free cash flow, and instead of taking that cash out to buy a coffee, you automatically use it to buy fractional shares of the same company,
So over time, your share count snowballs.
which means your next dividend payout is even larger. It's a beautiful self-feeding loop.
And the fourth vehicle takes a pretty hard left turn compared to the others: digital and online assets.
Yeah, this one is unique.
The document explicitly separates this from the other 3. It notes that buying digital assets or online cash flowing properties requires active skill. It's treated as business investing, capable of producing asymmetric higher returns.
And that's a crucial distinction to make. Index funds and dividend stocks are passive equity. You provide capital, you step back. Digital assets, whether that's acquiring a niche content website, building a digital product, or even some decentralized finance applications, require sweat equity.
You're taking on operational risk.
Exactly. The higher potential returns aren't a free lunch. They are your compensation for acting as a business operator rather than a passive shareholder.
So we have these 4 distinct vehicles. But the core thesis of the paper hinges on the underlying math that powers them in Part 4, the power of compounding.
The eighth wonder of the world.
The source provides this highly specific stripped-down example. If you allocate just $100 a month, assuming a 10% annual return over a 30-year horizon, your portfolio will cross the $200,000 threshold.
What's fascinating here is the ratio of principal to growth.
Break that down for us.
Let's look at the mechanics of that outcome. Over 30 years, contributing $100 a month means your actual out-of-pocket principal is only $36,000.
Right. $1,200 a year times 30.
Yet the terminal value is over $200,000. The vast majority of that final number, over $160,000, is entirely generated by the mathematical velocity of compounding.
That's the interest-earning interest.
Precisely.
Now, for an audience that tracks real returns, we obviously have to acknowledge inflation. $200,000 in 30 years will not have the purchasing power it does today.
No, of course not.
But even adjusting for a standard inflation rate, the multiplier effect on that original $36,000 is staggering.
The real challenge is surviving the boring middle.
Oh, absolutely. The first 10 years of that compounding curve look almost entirely flat. It takes tremendous psychological endurance to keep feeding the machine before the parabolic growth actually kicks in.
Which perfectly validates the author's core thesis. Compounding is completely indifferent to the size of your initial lump sum. It strictly rewards consistency and time in the market. It is a duration game.
Okay, let's translate this into actual blueprints. How does a listener look at their surplus and physically divide it up?
Part 6 gets into this.
Yes, the tech provides practical sample allocations based on specific monthly surpluses. Let's examine the $50 surplus first.
A very tight margin.
Very tight. The recommendation is a highly concentrated split. 70% goes into an index fund and 30% into the emergency fund. So that's $35 to equities and $15 to cash defense.
Right.
Honestly, splitting $50 feels incredibly granular. Does the math actually justify the friction there?
Mechanically, yes, it does now. Thanks to the advent of fractional shares and zero-fee brokerages.
That's a good point.
10 years ago, the trading commissions alone would have eaten that $35 allocation alive. But today, you can deploy it seamlessly. The logic behind this aggressive 70-30 split is that when your surplus is that tight, you are in the maximum accumulation phase.
You have to force capital into growth assets.
While simultaneously building the shock absorbers, yes.
The blueprint opens up significantly when we look at the $200 monthly surplus scenario.
The options expand.
They do. The suggested allocation shifts to 40% in index fund, 20% in a money market, 20% in business experiments, and a surprising 20% allocated to skill development.
That last one is huge.
I found the inclusion of skill development really surprising. We usually think of investing strictly in terms of equities or real estate. But treating a certification course or a masterclass as a discrete asset class that completely redefines personal finance.
I'd argue it's the most sophisticated insight in the entire paper.
Really?
Absolutely. When you are operating with smaller capital, your absolute highest yielding asset is your own human capital, your earning capacity.
How so? Give me an example.
Okay, if you take $40 a month and deploy it into an S&P 500 index fund, you might yield $4 in a year.
Right.
But if you take that same $40, bundle it, and buy a technical certification or a software tool that allows you to negotiate a 20% bump in your freelance rate or your salary.
The ROI on that capital is exponential.
Exactly. You are literally expanding the shovel you use to dig for surplus cash.
That perfectly bridges into the structural roadmap the document outlines in Part 9, which they call the wealth ladder.
The progression.
It's a 6-step progression, ordered strictly by priority. Let me walk through it. Rung 1 is income stability. Rung 2, the emergency fund. Rung 3 is index investing. Rung 4 is the dividend layer. Rung 5 is business expansion. And finally, sitting at the very top of the ladder is Rung 6, alternative assets.
Notice the deliberate sequence there.
Right. You can't skip steps.
You don't transition from Rung 3, the broad market index, to Rung 4, the dividend layer, until you have established a massive baseline of capital appreciation. And you certainly don't touch Rung 6 until the first 5 are locked in.
Let's spend a moment on that sixth rung, alternative assets, because the text places it at the absolute peak of the journey. We're talking about private equity, real estate syndications, venture capital, cryptocurrency.
The shiny objects.
Exactly. The temptation for anyone entering the market is to skip straight to rung 6 because that is where the asymmetrical lottery ticket returns live.
And that is exactly why the author quarantines it at the top of the ladder.
Quarantines. I like that word for it.
It's necessary. Alternative assets carry massive illiquidity premiums, and they operate outside standard regulatory frameworks.
So if you buy into a real estate syndication,
Your capital might be locked up for 7 years. You cannot liquidate it to cover a sudden tax bill. If you haven't built the foundation of liquid index funds and a cash buffer beneath you, entering the alternative space isn't investing.
it's unhedged speculation.
Exactly. It's gambling.
So what does this all mean? We have the mathematical models, the allocation splits, and the structural ladder. But the architecture is completely irrelevant if the operator panics.
The human element.
Right. The system requires a highly specific psychological framework to function. Which brings us to the mindset rules.
If we connect this to the bigger picture, the operational mechanics of investing are actually quite simple. The hard part is managing your own neurochemistry.
It really is. The text outlines some non-negotiable rules for your brain in Part 7. First, automate.
You must remove the decision fatigue.
Right? Manually transferring capital every month is a trap. If you have to consciously choose to invest over consuming, eventually consumption wins.
Every time.
Second rule, ignore the daily noise. The financial media ecosystem is optimized for engagement, and engagement is driven by anxiety.
They want you panicked.
They do. The text also demands that you review your portfolio only on a quarterly basis and force your brain to think in decades, not days.
That is brutal for human psychology.
It is. Our brains evolved to react to immediate threats, to run from predators today, not to optimize for a statistical payout 30 years in the future.
Which is exactly why the risk management rules in Part 5 are so rigid. You have to protect yourself from your own evolutionary instincts. The first rule is absolute. Never invest money you cannot afford to fluctuate.
Period.
If your timeline for needing that capital is under 3 years, it has no business in the equity markets. The sequence of returns risk is just too high.
The second rule is diversification. But there is a nuance here that the author brings up later in the common mistakes section. Let's talk about over-diversifying early.
Ah, yes.
We hear the word diversify preached constantly. But if you only have a $500 portfolio and you try to manually diversify by buying $2 fractional shares of 50 different companies
You're just diluting your focus.
and creating an administrative nightmare, the broad market index fund does the diversifying for you.
It's a classic beginner trap. You mistake complexity for sophistication. When your capital base is small, simplicity is your ultimate leverage.
What are some of the other traps the text highlights in Part 8?
They're mostly behavioral. Waiting too long to start because you are paralyzed by analysis.
Analysis paralysis.
Right. Treating the market like a casino by attempting high-frequency day trading instead of long-term investing. And blindly following macroeconomic hype cycles.
Which leads to the ultimate sin in wealth building, capitulation during a drawdown.
The worst mistake you can make.
Selling out of your positions simply because the market is experiencing a cyclical contraction. If you've followed the framework, if your emergency buffer is fully funded, if you are only investing surplus capital you don't need tomorrow, and you are genuinely thinking in decades.
A 20% market drop shouldn't trigger a panic response.
Right. It's just the cost of admission.
It is the behavioral toll you pay for the long-term yield. Capitulation only happens when your portfolio timeline is misaligned with your life timeline. If you are forced to sell, it means you violated the rules on rung 2 and skip straight to rung 3.
As we synthesize all of this, the core wisdom of this document is profoundly empowering.
It really levels the playing field.
It does. Wealth is not a gated community reserved for those with massive initial capital. It is an algorithmic output.
Built through relentless application.
Consistency, disciplined capital allocation, intelligent risk-taking, and an unshakable long-term horizon. You start with whatever surplus you have. recognize it as your training capital, and begin building the infrastructure.
And as your income scales fueled by that 20% allocation to your own skill development, you simply push more volume through the exact same pipes. This raises an important question, and it is the critical takeaway I want you to analyze as you look at your own financial landscape.
Let's hear it.
We've established that your initial smaller investments are your training capital. They are the reps that build your operational and emotional discipline.
Right.
So look at your automated transfers, your cash buffers, and your reactions to market volatility. What are your current daily money habits training you for right now?
Oh, wow.
Are they systematically preparing you to manage and multiply the wealth you haven't even generated yet? Or are your current behavioral patterns quietly training you to lose it the moment you get it?
That is a phenomenal diagnostic question to leave on the table. Thank you for joining us for this deep dive.
Right.
You have the structural blueprints, you understand the mathematics of the long game, and you know how to leverage your surplus as the ultimate training tool. Take that first step and lock in your foundation today. We will catch you on the next one.
That's it for today's episode of Wealth Hustle 247. Be sure to follow, like, comment, and share with others. Keep pushing toward your goals, and we'll see you in the next episode.